Hello everyone and welcome back to my channel. I hope you are all doing okay. So previously in my latest videos, I shared with you my strategy that is based on moving from internal liquidity to external and vice versa. And most of the examples I showed related to the strategy were Forex examples. And I received a lot of DMs from people asking me if this strategy works in the future markets, specifically with the S&P and the Nasdaq, and if the time windows are the same. So instead of replying to each one of them, I have decided to make a video about it, and I'll show you exactly how to adapt the strategy to the indices. And I'll demonstrate that with a live trade example, so you can be reassured that this is not insight. I'm genuinely sharing the strategy that I trade with every day. I know some of the traders would open a paid Discord server just for this. Anyways, besides this, I will also show you another form of a market structure shift. I know many of you are familiar with the traditional market structure shift when a displacement click breaks a recent swing. In this video, I'll introduce something a bit more advanced and I'll try to simplify it for you guys. So if you are interested in that, then stick around till the end and don't forget to hit that like button and subscribe to the channel so you won't miss any upcoming videos. And let's get started. So here's the strategy that we're going to use, right? It is pretty much the same, but we're going to change the time window right here. The time element is an important factor in ICT teachings. So instead of using the old 2 a.m. to 5 a.m. and 8 a.m. to 12 p.m. New York local time, now we're going to use 9:30 all the way to 4 p.m. And some of you would argue and say, yeah, but ICT advised us to not trade the lunch hour, right? So 12 p.m. to 1 p.m. and trade after 1:30. Well, based on my experience and my backtesting and my journaling data, the lunch hour is tradable and it delivers price to the intended levels, right? Most of the time is not that choppy like ICT said. And if you don't believe me, then I want to show you something. So this chart is from ICT Twitter, right? He shared that. And this is a 30-second model. And as you can see, and it is actually an old model. So it is basically a market maker sell model, the one that I'm sharing with you here. Just with a fancy name, no offense. So here's the original consolidation right here, accumulation, and then reaching to a higher time frame level. In our case, he uses the 5-minute and then 30-second for execution. We have this order block, right? And we have that sweep on liquidity. So we do have here, right? Sweep and then smart money reversal and delivering to the sell side liquidity. So the market is shifting from short-term bullishness into long-term bearishness. He uses a time frame alignment of the 15-minute and the 1 hour for buys, and then he wants to see a 5-minute rate, right, buy side liquidity, and then once the candle closes below that buy side liquidity line, and then he would zoom in to the 30-second and look for entries. The point is, if you drop down to the time axis, you will see that this move right here happened during the lunch hour, so from 12 p.m. to 1 p.m. and also delivered price from 1 p.m. to 1:30 into the intended level and this sell side liquidity. So this is why I included the lunch hour into this time window. And now let's move on to the chart. So I'm not going to explain each one of these steps into details, right? So I have already did that in a 30-minute video. Instead, I'm going to show you how to apply each one in a live chart example, right? And I believe this is better because you will see how to apply these steps into the chart. And before we start, here's a trade. So this is my first entry right here. I took the trade on the 1 minute. And here's a second entry. So I took another entry and exited here. And as you can see, after price reaching to that liquidity level, and of course taking this failed swing right here, immediately rejects. So choose your targets wisely. And now let's move on to the chart. So here I have the daily chart of the US 100, and let's apply each step to this and align each time frame with each other. So let's start with the bias, and as always we're going to use either the weekly or the daily or the 4-hour, and we have these two elements. So from internal range liquidity to external, and from external to internal, and in our case we have internal to external. So basically price took external range liquidity right here with this energetic move to the downside, right? And after price taking external, and we want to look now for internal, and we have that here. So this fair value gap and this one. Internal is represented with fair value gaps, imbalances, so gaps, volume imbalance, and most often fair value gaps. So as you can see here, price is here, took this daily fair value gap, which is internal range liquidity. Our next target should be now external range liquidity. So this is it. This is the bias. Bias explained in 1 minute. This is all you need from the daily time frame. I'm not gonna outline each period on here. All I need is internal to external. That's it. Now after forming the bias, now we want to go to the next step, which is the narrative or the confirmation. And in our case, we're going to use the 1 hour. So daily with 1 hour, right? And in my previous videos, the videos that I outlined how to execute this strategy, I showed you many examples and I did live trade breakdowns. Pretty much all the examples. And the second step, which is the market structure shift, was in the form of this. So I told you to look for a sweep first or an SMT, right? And we have that here, sweep, and then look for displacement to the downside, taking recent swing, and then once price return to a period from that displacement, now you're gonna look for the third step, which is the execution, and you're gonna look for another market structure shift. In this trade, I did something different. So I didn't wait for this to happen, and as you can see, it happens here, but I didn't wait for it to happen. So the logic of this step, so why do we need this step and what is the point of it? The point of it is we are doing time frame alignments. So we start with the daily and we determine if it is bearish or bullish, right? And now we want to see these time frames. The hourly is also bearish, right? And finally, we look for the execution time frame also to be bearish. So we are aligning the time frames with each other, and we wait for them to point to the same direction. So the question is, how did I know that the hourly is already turned bearish and I didn't wait for all this to happen to take this trade? And let's start. What do we have here? Price on the hourly time frame was bullish, right? It took this daily fair value gap. So this is internal range liquidity. And as you can see, it is also an external range liquidity. So price took daily internal range liquidity and took external hourly liquidity. Now, if we zoom in to this piece of price action right here, and especially this candle right here. Now, what was the state of delivery on this candle right here? We were on a buy program. And why is that? What is the purpose of this buy program? First of all, we took that external hourly range liquidity, right? And the second purpose is piercing into that daily internal range liquidity. So this daily fair value gap. So this candle right here was in a buy program to take external and internal range liquidity. The next candle, which is a 10 a.m. candle, and we had news. So the open, it took liquidity from here. So we have manipulation, right? The news manipulation, and immediately rejects and closes below the range, and of course below this opening price right here. When we see this formation right here, you know that this is a change in the state of delivery, and this is the real order block. And if we go back to that picture ICT posted, you can see it is exact same structure. So we took buy side liquidity from here. This candle took the buy side liquidity from here, right? And then this candle swept the high from here and immediately reject, closing below the opening price of this candle right here. So when this candle closes below the opening price, this will become an order block, and we have a change in the state of delivery. And let me remind you that this is not the same chart. So this is the 5-minute chart from another day, I can't remember, and this is the hourly time frame. So these things repeat, guys. And as you can see, after we have changed in the state of delivery, this candle right here found resistance from this candle. So this is a real order block, guys, and this is the first sign that the hourly is changing from bullish, right? So bullish to bearish. This is the first sign. Let's go to the second sign, the second indication of price on the hourly going from bullish to bearish, and we have this bullish fair value gap. So we have a busy buy side imbalance, sell side inefficiency. As you can see here, price found support on here and then immediately reject, closes below it, right? Way below it. And after that, it turned to resistance. So we have an inverted fair value gap right here. And this is the second sign of changing the order flow of the hourly to bearish, right? The third sign, which is this breaker block right here. So this breaker block, we have an expansion to the upside, taking that external range liquidity and then immediately reject and closing below this two down close candles. And now we have a breaker block formation. So now we have three indications that the hourly went from bullish to bearish. And I don't need all this. I don't need the traditional market structure shift, breaking below this swing right here and returning to the PDRA and then looking for shorts. I don't need this. The moment this candle right here violates this breaker block, and also we have found support right here from the inverted fair value gap, we have also a change in the state of delivery. For me, that is enough to know that the hourly is in fact confirming my bearish bias on the daily. So I hope you guys understand this. And now let's move on to the second element of the second step. So we have that market structure shift, it happened, and now we have that market maker X model. Market maker X model is relatively easy to spot. We have that here. So this expansion leg right here, we have that original consolidation, and we have another accumulation right here, and then smart money reversal here, and it will look better if we go to the 5-minute time frame. So here we go, right? We use that for targets, right? Because the property of a market maker X model is a low resistance liquidity, and we have all these filled swings on it here. So now after we have that bias, we have that confirmation, all we need now is execution time frame, and we're going to use the 5-minute time frame for that. So again, time window 9:30 to 4 p.m. Local time, and we need to see a market structure shift from a PDRA on the confirmation time frame. And of course, we want to see sweep first or an S&T divergence. If we go here, now on the 5-minute time frame, some of you will say that this is the low risk sell. For me, this is a low risk sell. Why is that? Because after price violating that bullish fair value gap, right, and the breaker block, we have that here. Now this is the low risk sell because hourly is now pointing to the downside, and we have that market structure shift right here. A nice placement to the downside, and I told you to look for a sweep or SMT. Do we have a sweep right here? No, we don't have a sweep. But if you go to the US 500, so the S&P, and if you compare this high right here with this high took liquidity from here, this high couldn't take liquidity from here. So this is an S&T divergence, and we don't need that sweep. Between S&T divergence and a sweep, I prefer the S&T divergence, right? Because it indicates weakness in this case right here, and you can expect explosive move to the downside. So we have that market structure shift, and this is the low risk sell from this fair value gap right here. This would be a perfect entry to target all this liquidity from here. So as you can see, it is 12:20 p.m. So this is the lunch hour, and price delivered normally, right? It didn't chop or something. And you can take your entry from here. So on the low risk sell, and the plan is completed, and everything is aligned with each other. Anyway, I missed that entry right here, so I had to look for another entry. So we have another displacement to the lower, right? Broken this, and I was waiting to take my entry from this fair value gap right here. We didn't have that, and then we have another candle right here, We have this up close candle. So now I'm not expecting price to go all the way to here. Why? Because on a sell program, we can expect up close candles to push price to the downside and act as resistance. So I had to go and find another entry. So if you go to the 1 minute time frame, I don't like this time frame, but it is necessary. If you missed this right here, so we have the displacement right here on the 1 minute, and I took my entry from here. My stop loss was above that 5 minute up close candle that I showed you. So this one right here, and I was targeting that sell side liquidity. And I took another entry from here, from this fair value gap, with half the risk. So I believe we have come to the end of this video. If you guys have any questions, please DM me on my Twitter account or leave a comment down below. I'll answer you as soon as I can. Happy trading and good luck.